ticker symbol QLYS, is down almost 40% in the past year. Qualys is a stock which has been getting a lot of attention recently, as it is one of those stocks which is trading very near to their 52-week lows, but a lot of investors are actually making a fair point that this actually looks like a very solid buy. Investors are even going as far as to call this the new PayPal, which is a stock that actually rebounded by almost 57% from its lows in October 2023. And the truth is that the case with this stock is not so different, because although the price has declined by a lot, the fundamentals of the company are still very sound. Just look at their annual growth. Every single year, their revenue and net income have been growing consistently, and the same has been going on when we look at it quarter by quarter. Additionally, they have a very solid balance sheet with their assets being way above their total liabilities, and their yearly cash flow generation is very solid. Firstly, for those of you who do not know the company, Qualys is a cybersecurity company which is focused mainly on vulnerability management, which basically allows companies to secure all of their data and decrease the chance of a cyber attack actually being successful at their companies. And the reason why this is actually classified as a compounder is because its revenue and also its bottom line, either its net income or its free cash flows, have all been growing very consistently and compounding over time. As you can see on the graph to the right, their levered free cash flow has been increasing at a very solid pace all the way from 2014 up until now. And the thing is that their net income has been growing at a 49% CAGR in the past 10 years. Their revenue has also climbed from 134 million in 2014 all the way up to close to 600 million right now. That is a growth rate of above 17% for the past 10 years. Extremely solid. And the thing is that their ratios have only been improving, and this is something extremely important because their return on invested capital, their return on capital employed, and all these metrics have been allowing this company to grow at such great rates. And right now, these are the highest they've ever been for Qualys. But something even more important is that they've been able to also grow their profitability apart from being able to grow their top line. As you can see on the right, their profit margin has stayed extremely consistent, their EBIT margin has grown at a very fast pace, and most importantly for us, its levered free cash flow margin has gone from around 20% in early 2015 to over 40% in 2024. But why has this stock actually been falling? Well, this article actually states that this has been due to some sort of expectations management, and arguing that it's because the company was extremely overvalued a couple of months ago. By reading this, we can understand that it would take over a 60% increase in price to just reach those levels where it was trading 1 year ago. One very important thing to note here is that Qualys right now has a free cash flow margin of 44%. Meaning that from all of its revenue, they get 44% of it back in free cash flow. Extremely solid. And when comparing this to one of their major competitors, which is CrowdStrike, well, their margin is closer to 33%. So Qualys is not only growing at a faster pace, but it's a lot more profitable. I say this all the time. When companies are trading at very high price to earnings ratios, the market starts to become a lot more demanding, because a higher PE ratio normally demands a higher growth rate. So in the moment that one of Qualys' earnings actually came a little bit negative and their growth wasn't as fast as it was supposed to be, then a lot of investors started ditching the company, making the stock price drop at a very fast pace. This analysis also argues that one of the main KPIs in their annual report that actually caused the stock drop was their revenue growth from existing customers. This basically represents their ability to upsell or to cross-sell to their existing customer base, and this actually declined from around 110% in Q2 2022 all the way up to 102% in their latest quarter. This, of course, is a very big drop because it means that the company will now have to rely on seeking new customers in order to grow their revenues, which is of course a lot harder than to just upsell and sell new services to your existing customer base, because at the end of the day, they know you better and they know your service. So if you're doing a good job, they will want to buy more from you. But then this article also goes on to conduct a valuation analysis for the company using, of course, the discounted cash flow calculator. So the result of this analysis is that 4% that you can see on the left. What this basically means is that at the current price of the stock, the market is expecting that Qualys will grow its free cash flow per share at a 4% year after year. I do agree with the author of this article in that this is very pessimistic, because, as we have seen previously, Qualys has been able to grow their levered free cash flow at almost a 39% in the past 10 years. Additionally, he then uses the analyst's revenue estimates, which are at around 8% per year for the next 3 years, and he analyzes that if Qualys managed to grow their revenue at this 8% for the next 10 years, this will give you a 10-year free cash flow CAGR of 6%, meaning that from this exercise alone, the stock appears undervalued. Additionally, he then states that even though it now looks like it's undervalued, the stock is still in a long upturn trend, where in the past 10 years it has been rising consistently and long-term shareholders have still benefited massively from price surges in this stock. And one thing I really like about this article is that then he speaks about some downside risks. The first risk he does state is the one we spoke about earlier, where they have been finding it a lot harder to actually upsell and cross-sell to their existing client base, which is affecting their revenue growth rate at a pretty significant amount. A second factor he sees is that competition in this sector is extremely strong. Every year there are more data breaches and cybersecurity scandals around the world. This is making companies spend more than ever in cybersecurity. And this is attracting so many new companies to enter this space since it's very profitable at the current moment. We have companies such as CrowdStrike, Palo Alto Networks, even Microsoft is a big player in this market. So if you start doing things a little bit wrong, customers don't like you as much as they used to before, all your growth could go away and make all your competitors even bigger. So overall, the author of this article rates this stock a flat-out buy because of its solid fundamentals and its current valuation, where despite all of the current headwinds, he still sees value in Qualys stock. And now to summarize things up, I believe that the main reason why Qualys is trading down by so much is because it used to have a very high multiple back in January 2024. Since growth has slowed down all the way up to 8% on a year-to-year basis, this is what has caused the stock to drop so low and now be sitting at a PE ratio closer to 27 times, which is more or less where a company with its growth rate should actually be. However, I do believe that this company has great fundamentals, it's trading at a very nice place in relation to their peers, they have very solid bottom lines with very healthy margins and very solid efficiency ratios, and I will personally be conducting a further deep dive on this stock because by conducting this analysis, I actually believe that there may be huge potential with Qualys stock. So thank you for watching. As always, this has been the Cashflow Compounder. I hope you find value out of this video, and I'll see you in the next one.